This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney. Alex Steele is out this week. On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we look at the future for U.S. equities as a double dip looms. Plus, can global internet continue to grow despite a decline in ad spending? But first, European banks are set to enter 2024 with profitability and capital strength at decade highs, despite lackluster sentiment. For more, we're joined by Bloomberg Intelligence Financials analyst Lento Tang. Lento, thanks so much for joining us here. Give us a backdrop here of how the European banks have performed in 2023 and kind of what your outlook is for 2024.
Yeah, sure. Thanks. So for European banks, they are at a very weird position at the moment. As you just mentioned, they are at record high revenue, record high net profit. Their capital is also record high. But if you look at the forward PE, it's at 15-year low at just above 6 times. And their implied cost of equity for 2024 is 17%. That's the median. So we are at this weird position that if we look at the fundamentals for 2023 and even 2024, if we look at the numbers, they look absolutely fine. But the investor sentiment seems to be very much on the downside. I think that just reflects how much risks currently are in the market. We have the margin pressures because we already see the rates peaking, and the market expects Bank of England and ECB to start cutting rates by June next year. And then we also see the economy is slowing down. There are windfall tax risks. There are commercial real estate. And then obviously there was geopolitical risks as well.
Where are we in terms of valuation for this group?
So the forward PE is just above 6 times. And then the price to book value is roughly just below 0.8 at the moment.
So that sounds cheap. Anytime you get these things below, book value, isn't that historically a time to maybe just hold your nose a little bit and buy them?
Yeah. I mean, for banks, they have been below 1 for a very long time.
Yep.
And so that is normal for banks. But in this case, the banks are trading at this level with a historically strong fundamentals. So this is something that's special.
How about dividends here? Where are we with the banks and their dividends and returning capital to shareholders?
Mm-hmm. Yep. So share buybacks is definitely a hot topic this year because of the profit boost that every bank has. For the dividend yields, we are seeing some banks that are posting even more than 10% dividend yield. So that looks quite attractive. One thing I have to say is I think when we are at a high interest rate environment, people tend to look at value stocks, stocks that pay high dividends. So interestingly, we also see that the stocks that have dividend payout ratio larger than 60%, they tend to have higher PEs on our scores. So that includes Nordic banks, and then in comparison, the ones not doing so well in the dividend payouts, they tend to have lower PEs.
So how are investors kind of looking at this group? Are they just trying to find the best quality? Are they looking for the best valuation? Or are people just saying there's just too many headwinds here?
Yeah, I think that's a very interesting question. So I think there are some regional differences at play here because if we look at the key metrics to look out for European banks next year, it will be, well, in my opinion, there will be two, which is one is NII or net interest margin. The other one is cost of risk or loan loss provisions. So for NII or net interest margins, we see the southern European banks, so Spanish and Italian banks, they have very strong retail bases with limited competition in terms of deposits. And because of that, they've been able to control their cost of risk quite well while passing the interest rate hikes in terms of lending. So that really boosted their net interest income, and that is probably going to continue through the first half of next year.
Okay.
In comparison, the UK banks are not doing so well, and they are also one of the worst performance this quarter because, for example, like NatWest and Barclays downgraded their net interest margin guidance. So we definitely see the regional differences here.
Yep. All right. Very good. Some challenges, certainly, as we look at to 2024 with the European banks. Our thanks to Bloomberg Intelligence financials analyst Lento Tang. All right. Keeping with banks, let's turn now to the U.S., where regional banks are facing headwinds after months of banking drama and aggressive rate hikes. For more, we're joined by Bloomberg Intelligence senior U.S. regional banks analyst Herman Chan. So, Herman, we got through in 2023 some of those the early failures earlier in the year.
That's right.
Kind of reset for us where investor sentiment is for the U.S. regional banks here.
Right. So the initial turmoil that happened in March, April, and May, things have really subsided. Deposits have stabilized after a lot of questions on if banks were going to be able to sustain their deposit bases, given what happened with SVB and Signature and First Republic. Where we're at now is that the market's trying to digest how banks are going to counteract some of the headwinds that are affecting the banks in terms of higher interest rates, squeezing net interest margins, tougher regulation, which is going to hurt the profitability of the banks, and also credit quality, which really hasn't been weakening as much as some prognosticators had expected. But that's going to be another shoe that's going to drop next year potentially. So valuations have really declined and are still near trough levels. We're talking about 1.1 times tangible book value, which is really low by historical standards. So all this negativity is priced into the stocks at this point, and there could be some optimism next year in 2024 with margins potentially peaking and potential rate cuts next year, which would alleviate some of the deposit pressure that's been affecting big margins.
Has the net interest margin, the net interest income margin, has that been a positive or a negative for the banks? Because I always thought with rising interest rates, that's good for the banks.
Yeah, it usually is. But what's the big difference versus the traditional notion that higher rates are better for banks is that the Fed was really aggressive with rate hikes. And last year in 2022, banks benefited from the initial pickup in rates. They gave those back in 2023 as higher funding costs started catching up and banks saw deposits go out the door. So they had to reprice their deposit base a bit quicker than initially expected just to stabilize their deposit portfolios. Going forward, there should be a bit of equilibrium as the Fed is potentially done with rate hikes and fixed rate asset repricing. You're talking about mortgages repricing, business loans repricing. That's still a tailwind. And if the deposit pressure alleviates a bit, margins can start to stabilize.
All right. So that's the interest rate issue. How about just the overall economy? Because when I think about regional banks, I think about local businesses and local economies. And so
that's right.
Is the recession risk priced in, if in fact there is a recession out there?
Yeah, what the banks are saying is that there's still some questions from their business borrowers, and regional banks mainly focus on small businesses, small commercial real estate operators, and consumers. What they're saying is that there's less demand out there because there's uncertainty with interest rates where they are today. There's a lot of sticker shock in terms of when a potential loan is coming due and the pickup in rates that these borrowers are facing. So that is dampening activity in terms of lending. And then there's also the bank's part where they're actually shying away a bit in terms of supplying loans to their local economies due to the fact that they are focused on building capital ahead of tougher regulation. So that's another factor that's really affecting the loan dynamic in terms of supply and demand.
So just real quick here, are buyers coming in and saying, I'm going to buy the highest quality regional banks and just kind of wait, I got to be patient?
Yeah, we've seen some folks out there, Bill Gross is an example, that talked about the bottom in regional banks has arrived. So there are some folks out there that have talked about potentially coming in and being more aggressive. It remains to be seen. There are still a number of headwinds and challenges, but valuation is definitely your friend at this point.
All right, our thanks to Bloomberg Intelligence Senior U.S. Regional Banks Analyst Herman Chan. Coming up on the program, can U.S. equities avoid a double dip? You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
A second dip in the U.S. economy is likely underway and could create complications for the S&P 500 as 2024 kicks off. For more, we're joined by Bloomberg Intelligence Director of Equity Strategy, Gina Martin Adams. So, Gina, I don't know. I kind of feel like the economy's okay. I kind of feel like I've seen peak rates. The earnings are pretty okay. It sounds like a pretty constructive model for equities next year. What do you think?
Yeah, so the economy is not everything. This is one of the models we run. So that's the first thing. I got to hedge my bets a little bit. And the earnings outlook is generally improving. Or that said, the economy does mean something. And I think that what we want to consider is sort of where we've been is very meaningful for where we're going. Our economic regime model told us that the economy weakened a lot in 2022.
We have an economic regime model?
Yes. This is where we get our double dip idea from. The regime model said that 2022 was a very, very weak year. That did coincide and turned out to be a pretty good signal for what was to come in earnings.
Okay.
It also said 2023 was going to be a pretty good year.
Okay.
And it did coincide with a recovery in earnings. So now it's saying, look, things have dipped again. And we want to be somewhat cautious as to what that means for the earnings stream. That said, it's not the only meaningful indicator. We have 9 different models that run for the U.S. equity market. And our market regime model says single-digit moderate returns are still most likely. Our market pulse index suggested people got way too bearish on the equity market. There was too much fear in the equity market as of October. Our earnings model says even if the worst, the pretty dire macroeconomic scenario comes through, the index can still post about 2% earnings growth over the next year. So I think it's all worth putting in context. Yes, the economic regime model is saying that the economy has weakened quite a bit to start the fourth quarter, but the degree of weakness and how that translates into the earnings outlook is going to be really consequential for stocks going into 2024.
So we just got through the third quarter reporting cycle, and it sounded to me like, relative to expectations, they kind of did okay, most companies. But guidance was still conservative. And I guess that makes sense because everybody's been talking about a recession for so long. And we are, in fact, starting to see some slowdowns in some key indicators, as you mentioned. But I just wonder if maybe the companies have under-promised and maybe can over-deliver next year.
Yeah, I think that there are some weak spots in the earnings stream that we want to be cautious toward, even though earnings did recover much stronger than analysts had anticipated. As a matter of fact, when you exclude the energy sector, which remember is a cost input for the rest of the sectors of the S&P 500, but when you exclude that energy sector, we're looking at nearly 10% earnings growth in the third quarter. So earnings are recovering at a pretty rapid clip. Remember, this time last year, earnings were contracting.
Right.
So we've seen some earnings recovery certainly emerge. Some strength, absolute strength in technology and communications has emerged, and those are 2 of the biggest sectors in the S&P 500. But some really significant weakness also in healthcare, especially. It's by far the weakest player in the S&P 500 right now. And given guidance trends, the consumer sectors are weakening quite a bit. So I do think what the story for the equity markets, and this has really been the story for the last 2 years, is pick your spots carefully.
Okay.
It's a really tough market to just, dump capital in and expect all stocks to rise. It just doesn't happen in an environment where rates are much higher. Inflation volatility is still quite a bit higher. The outlook is so uncertain. You do want to pick your spots carefully, but there are spots where we're seeing pretty significant growth.
What's the valuation call here? Because I know you kind of have to strip out the Magnificent Seven, and if you do that, one could make an argument that we're maybe the decent valuation point here.
Yeah, I'm glad that you say that, Paul, because the vast majority of people tell me, stocks are just way too expensive. And they say that based upon that headline index number, which does look pretty pricey. But frankly, even our fair value model says you should be paying, given the current combination of interest rates as well as the yield curve and the likely outlook for macroeconomic growth, you should be willing to pay just over 19 times earnings for the S&P 500.
Okay.
So we're not that far off on a headline anyway. But when you exclude the tech stocks from that number, you're looking at the market trading at closer to 15 times earnings, near 16 times earnings, which is much closer to long-term average on an equal weighted basis. Large cap stocks, for all their faults, are still trading below their pre-pandemic averages. So the index, I think, again, you got to pick your spots. You've got to look beneath the headline for the S&P 500. That said, within the small cap world, you'd struggle to find a stock that's not cheap.
Yeah,
so
exactly.
It really depends on what you're talking about when you're talking about whether or not stocks are cheap or expensive. The indices aren't going to tell you the whole story.
Well, you have a lot of great charts and graphs that you include in your research reports. My favorite is the S&P 500 sector scorecard, because it's color coordinated, and that really helps me understand what's going on here. So what sectors are kind of screening well for you and what sectors are not?
Yeah, so at the top of the scorecard, still some of the big players from 2023, their dominance is suggested to persist by the sector scorecard. And by that, I mean communication stocks as well as technology stocks still have some of the strongest price momentum scores in the index. They also have generally positive revision breadth and earnings scores. Even though tech is very expensive relative to long-term averages, communication stocks, where a lot of tech-adjacent stocks live, is still very, very cheap.
That's still like the Facebooks and the Googles of the world.
That would include the Alphabet and Meta and Netflix, as well as Disney, but also then AT&T and Verizon on the other end of the kind of spectrum. So those are the positive segments. We've also got energy and financials up toward the top of our scorecard, which creates a really interesting combination of value and growth components right now. Financials, I'd say, is the biggest risk. It's the one where, I feel a little bit less less optimistic, but the scorecard is there for a reason. The scorecard is signaling that, you've got some pretty strong earnings trends and revision breadth improving in the financial sector, potentially playing off of the yield curve steepening that we've started to see. On the other end of the spectrum, it really is all the defensive sector staples is bang on the bottom of the scorecard. So some of the more defensive components, staples, real estate, materials, utilities, some of the segments that are very sensitive to interest rates and interest rates remaining potentially higher for longer are still ranked at the bottom.
So 2024 is an presidential election year. How does that usually play out for the markets? Do people get more risk averse when they get at or near close to the election? Yeah,
it's a good question. I think every election year is different. Third year of an election cycle is usually pretty good. So we seem to be following that election cycle. I think the most important thing to watch for with respect to the election really is how's the economy moving and how are inflation expectations moving, because really it's the economy that tends to drive the election cycle, in particular when the economy is weak. You do not see a president reelected if he's sitting presiding over a recessionary condition in the U.S. economy. It just doesn't happen historically. So that certainly is a risk to watch next year. And then inflation and inflation expectations are hugely important for assessing the consumer. The consumer has generally continues to earn money, but that dollar is stretched in this environment. And so inflation has become a really big part of psychology, and we want to see inflation pressures continue to ease to make the consumer feel better.
Well, we had Jen Bartashus on earlier, and she was saying what she's seeing in the packaged food companies and then the supermarkets. Those prices actually coming down. Commodity prices have come down. And I said, no, we're never going to see lower prices at the supermarket. And she said, no, it does happen.
That could be hugely supportive for the consumer. and the consumer impression of the economy. It's terrible for consumer staples companies because their margins are just getting creamed.
Our thanks to Bloomberg Intelligence Director of Equity Strategy, Gina Martin Adams. Coming up on the program, we'll see if the global internet can now withstand an ad spending slowdown. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. Help from generative AI is unlikely to come in the near term as internet companies contend with lower brand ad spending and pricing. For more, we're pleased to welcome Bloomberg Intelligence Senior Technology Analyst Mandeep Singh. All right, Mandeep Singh, are we talking about the Googles and the Metas and the Pinterests of the world?
Yes, and when you look at internet, predominantly it's digital ad revenue, but there are marketplaces like Uber, Lyft, DoorDash, and so that's how we segment Airbnb. That's how we segment, the internet space. And all
right, let's go to the to those ad-driven ones. I mean, it's been a story for 10, 15, 20 years of digital advertising media taking market share away from some of the traditional media, whether it's television or whatever. Where are we in that spectrum here?
Yeah, that trend is still intact, and that's why the digital ad market grows at a healthy 10 to 12%. The end market, when you think about the $600 to $700 billion market, and the overall ad spending is north of $1 trillion when you include the traditional TV spend as well. And these companies continue to do well because of the scale. I mean, I would say at this point it's a triopoly: Google, Meta, and Amazon. Amazon ads.
Right. And Amazon's new, right? They're relatively new entrant into the business.
$50 billion business, growing at a healthy 25% clip. So clearly, they have done what you would brand as a successful internet business, e-commerce plus ads, and other marketplaces like Uber, DoorDash, Instacart. We heard Instacart actually has 30% revenues from ads. Even though it's a marketplace delivery business, they've been able to layer ads to their business successfully. So that is the blueprint for a lot of these marketplaces to monetize their engagement, because the marketplace business isn't profitable. It's the ads that adds the high margin segment.
All right. So for the ad space in general, if the economy is slowing down, if we come into a recession, I know historically that's been bad for print advertising, broadcast television advertising. It's been a headwind. Similar for digital media?
Absolutely. I mean, look at last year when the inflation was high single digit. All these companies barely grew top line, 4 or 5%. In fact, Meta's growth last year was 1% when inflation was high single digit. So there is definitely an impact of macro factors on all these companies. But, search has always been somewhat more resilient, which is why the core Google search business has so far been insulated from macro, because it's the highest ROI spend. Now, it's another thing if ChatGPT could disrupt it or something else, which I guess now you could argue, things have changed and Google's competition or the threat from ChatGPT has lessened because of the turmoil that's going on at OpenAI.
All right, let's assume that kind of gets worked out, and that's a fluid situation as we speak. How do you kind of characterize the risk to Google's core search business from AI and ChatGPT in particular?
Yeah, so when you parse through Google's revenue growth, it's been around 10 to 11%, the core search. YouTube has been the fast-growing segment, but the growth did taper last year, and this year it has improved sequentially, but it's not back to the 20% growth that we are used to seeing with YouTube. I do think YouTube will come back strongly because they have acquired a lot of, live sports content, premium content, and that's where they will be, more shift away from traditional cable bundle to a YouTube streaming connected TV experience. And a lot of people are embracing that.
So it's interesting for these digital media companies. I saw like they actually had some cost cutting in 2023, particularly at Facebook / Meta.
The year of efficiency.
The year of efficiency.
Yeah.
Are these stories for investors? Are they still top line stories, or is it more profit margins, profitability, that kind of thing?
I mean, this year, clearly, all three companies, Google, Meta, and, even Microsoft, they had that boost from, cutting those fixed costs and the layoffs they did. Meta was the most aggressive with almost, 25% of the headcount slashing, and that reflects in their margins. So I think what will happen next year is they probably will have tougher comps when it comes to getting that lift from the cost cuts that they had this year. So that is you're lapping that next year, and now the focus is more on top line acceleration, which no one is sure about because the macro is so uncertain, and we haven't seen that lift from Gen AI. I mean, all these companies are investing in generative AI, but no one has figured out how to monetize it except for the compute aspect, which is where Microsoft Azure is like 3% growth contributor to that segment. Google Cloud, you could argue, would be 1 to 2 points of growth in that Google Cloud segment. But other than that, when you look at the scale of investments in Gen AI, the monetization is still far off. And that is where all the focus is. How are you going to monetize that Gen AI investment?
All right. So talk to us about the other part of your coverage. Kind of I'm thinking about the Ubers, the Lyfts, even the Airbnbs and things like that. How's that part of the gig economy, the tech economy?
I mean, this year was more about the scale players really establishing themselves. And in the case of Uber and DoorDash, they have emerged as the clear scale players here in the U.S., Uber globally, except for China. And that probably will help, improve the multiple, the valuation multiple that these companies have fetched, simply because over time, you don't have to spend as much on subsidies acquiring, supply on your platform as you had to do before. So I do think DoorDash and Uber's and Airbnb always had that profitability. But when it comes to delivery and ride sharing, Uber and DoorDash are emerging as the clear scale players.
And I guess if you're not scale like Lyft, you're just nobody, right, in the stock market.
Yeah, and investors are very much focused on profitability.
Yep.
That changed last year. So top line growth was not enough. You have to minimize your cash burn, and that's what went against Lyft this year because they lost market share to Uber, and they had a CEO change, and you just don't have the scale. So in hindsight, Lyft should have expanded to other areas. What Uber has done on the delivery side.
All right, so we're in the holiday season here. Everybody's traveling. You also cover the online travel agencies. How are they doing?
So, I mean, last 2 years have been phenomenal in terms of pent-up travel, and that's what I feel you've seen above average growth for these companies, whether it's Airbnb, Booking, Expedia. And travel so far has been that resilient segment in the economy. I mean, people still are traveling, and the numbers still look good. So at some point, I think the comps will get very tough for these companies.
Yep.
And you're starting to see signs of that, even with the hotel chains coming back. So what happened during the pandemic was the average daily rates really were a nice tailwind because the supply was limited.
Yep.
Well, with the hotels coming back, that ADR tailwind is fading, and that top line obviously is running into tougher comps. So we think there will be negative revisions next year.
All right, Mandeep, great stuff as always. Bloomberg Intelligence Senior Technology Analyst Mandeep Singh. Let's turn now to North American packaged food companies where top line and earnings growth could be more modest in 2024. To help us break down why, let's welcome Bloomberg Intelligence Senior Packaged Food Analyst and Retail Staples Analyst, that's a big title, Jennifer Bartashus. So Jen, talk to us about the packaged good companies. Let's start off with how did they do in 2023 and kind of what are the drivers for next year?
Yeah, so they actually have done okay in 2023. I mean, they're usually a defensive sector. So when people are pulling back, food companies tend to do well. They've had great earnings growth. A lot of that is a little bit artificial, though. So that when we look into 2024, there's really a couple of things. The first is that these companies have lost their pricing power. So they're not going to be able to raise prices going into 2024, something that they were doing consistently throughout this year. And then second, they've already taken the low-hanging fruit out of cutting costs. So it's going to be harder for them to trim costs, which means that earnings will be under pressure as well.
So why the diminished pricing power on the top line? Have they just kind of pushed as far as they can over the last few years?
Well, in the last few years, they've been pushing double-digit price increases consistently over and over and over again. And consumers are tired of it. And frankly, retailers are starting to push back as well because their mission is then to deliver lower prices. And some of the commodities are starting to come down in price. So the excuse that their input costs are still high is starting to fade. And that means that there are expectations that prices will come down as well.
So in the supermarket aisle, my box of Oreos that went up, I don't know, 20, 30%, it's never going to come down, is it?
Well, the price will come down. It might not come down to where it was in 2019, but it should come down from where it was half a year ago or a year ago.
Really?
It really
I always feel
does.
like the inflation, it sticks up top. And
it sticks when it's in the 2 to 3% range.
Okay.
But once you get into double-digit increases, it's got to come back down so that consumers have that perception that things are getting better.
Gotcha. So, all right. So it sounds like it's going to be a traditional challenge of, if I'm a packaged food company, just my mix, my price, that kind of thing. I mean, it's just that's blocking and tackling, right?
It really is. And this year it's all about volume. Because they can't raise prices, they're going to need to sell bigger volumes in order to spur their top line. But with consumers kind of pulling back, that means that they're going to have to do promotions, which are not always margin friendly.
Mm-hmm.
It means they have to do more in innovation, which is investment from an R&D perspective. So those are some of the dynamics that are pushing into what's going to play out as a very interesting year in this space.
All right. So how do you gauge kind of winners and losers here? Is it kind of management's track record? Like who can manage, the cost, the expenses, the inflation?
Part of it is a management track record, but also when you break it down and you look at which companies have taken the most price increases and which companies have taken the least price increases, in this environment, the people who have kept price increases to a minimum are the ones who are really positioned to do well. And we've seen that play out. So, for example, with Mondelez, they are one of the only companies that's seeing positive volumes because they kept a cap on how much they were really pushing through those price increases over the last year and a half.
Now, why would they do that? Just so they were playing a market share game?
In part, it was market share, and in part, it was their portfolio. So, Mondelez is really all about indulgences, whether it's snacks or chocolate, and those are categories where consumers were continuing to buy those products. So it's been a combination of demand from consumers as well as keeping those price increases at a minimum.
All right. So a lot of times when I think of some of these staples companies, and packaged foods are considered a staple, right?
Yes.
So return of capital to shareholders is important. How do these companies in this sector do it? Are they dividend payers? Are they buyback stock? A combination?
It's usually a combination, but nearly all of them are dividend payers, and they're all very proud of increasing their dividend on a regular basis. So we expect that to continue into 2023 with no change to that.
I know let's just say if we are going through recession, we've been saying this for a year and a half now. But how do these companies react typically? Well, they're safe havens, right?
Generally, are safe havens because when the economy goes bad, consumers retrench. That means they eat at home. That means they're preparing lunches to take with them to work instead of going out and buying lunch during lunch hour. All of those things benefit these companies in the long term.
So, any room here again? When I think about slower growth industries, potentially M&A is an area for growth. Have we seen any in this space recently, and do you expect it for next year?
There's some M&A. I mean, if you think about it, Smucker's bought Hostess, so they bought the Twinkies.
Yep.
So there's M&A, but it's been very targeted, and I think that's really what's going to continue next year. The companies you're not going to see some of these great, big, huge mergers happening. It's going to be more strategic in where they can find either a product to enhance their portfolio or a geography to enhance their portfolio that really is where M&A will shine.
And when I think about the shelves, I don't know, they look filled to me. So is the supply chain kind of back to normal-ish?
The supply chain is functioning well, I think is what we'll say. What happened during the pandemic was a lot of inefficiency was brought into the supply chain because there was a scramble to just make sure you had goods no matter what.
Yep.
now in the past 6 months and really into next year, a lot is going to be looking at how do you get that cost inefficiency back out. So optimizing truck routes, having complete trucks, uninteresting things.
Do your companies make an AI push here? Like to say, AI is going to revolutionize our business,
On the packaged food side, not so much. We're seeing it a lot more in the retailers who are looking to play with AI. But it's bound to come. It's just might be a little bit more delayed on the packaged food side.
So right now, as we speak, who's got the leverage, the packaged food company or the supermarket?
Right now, it's the supermarket.
Really?
And it's because if you think about it, supermarkets have a ton of private label products. So they are very, very conscious of how much it costs to manufacture an item. So when a national brand comes in and they say we want to have introduce a 3% price increase, well, they're saying, well, but corn is down, wheat is down. How do you justify another price increase? And it can't just be about labor.
Right.
And so the pressure now is really in negotiating with retailers who have that insight and are saying, look, we're keen to pass on savings to our customers. Grocery stores across all of retail are one of the first to bring prices down when inflation starts to ebb.
Okay.
And consumers feel that fastest and first in their pockets. And that's a heritage that the retailers are going to want to preserve. And so the pressure is really going to be on the packaged food companies to figure out how to make it work.
That's exactly right. I kind of felt like, as I think back to 2020, and that is the first place you saw it, wasn't it?
Yeah,
I mean, just like, what your bill is every month, more or less, or every week ago, it's X. Now it's like, boy, it's 1.2X. Where did that happen? I didn't buy anything different.
Exactly. But imagine when it goes back to that 1X, you're like, yeah, all right, I'm feeling good.
Yeah, I don't know. I'll have to see. Packaged foods, who knew? Our thanks to Bloomberg Intelligence Senior Packaged Food and Retail Analyst Jen Bartashus. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.